Life insurance policies. We're going to start with term insurance, which is kind of the beginning of all types of life insurance policies. It was kind of the first attempt to write coverage. The simplest, purest form of insurance is term insurance. It's always going to be the cheapest. There is never a cash value on term policies. That's why the premium is lower. Annually renewable term. This is also sometimes referred to as yearly renewable term. It means that every year at the policy date, the end of the policy, if you want the coverage to continue, you have to renew it for another year, and you're now a year older, so your premium goes up. You get to the end of that year, now you're another year older, so your premium is going to go up again because you're a year older. Because age, gender, and smoker, non-smoker are the three big factors in the cost of insurance typically. So it's kind of the first way to start. Term should be considered temporary insurance. Think T for term, T for temporary, because as you can see, every year you get older, your premium is higher. It will get very expensive over time. So one thing to remember also on the term, while you're in that term means a period of time, that year of the policy, the death benefit is level, okay? Every year the premium is what's going to go up. Your death benefit stays the same or is level. There are a couple of other ways that term insurance can be set up. Each one kind of meets a different need. The first one is called increasing term. What is increasing is the death benefit, the face amount, what's going to be paid to your beneficiary. The premium is the same, but your death benefit is increasing. Typically, this is used as a rider. You add it to another policy to get a bump in the death benefit for a few years. That's the whole purpose of them. So it's called increasing term. What increases during that term period? The death benefit. Could be a test question. The next type of term insurance, kind of a special version, if you will, is called level term. For a period of time, and you choose the period of time. It can be a 5, 10, 15, 20, or even 30-year level term. It means that the premium stays level as well as the death benefit for that period of time. So the death benefit is the same, the premium is the same. Let's say you do, it would be called a 10-year level premium. It's exactly that. The premium, instead of going up every year like stair steps, is going to be level for that period of time. 10 years, 20 years, 30 years. Also, the premium on this product stays level. Decreasing term is another type of term insurance. Again, the premium stays level, but the death benefit decreases. It goes down. And it's used for a very specific reason. Think debt. Decreasing term starts with a D. Debt starts with a D. It'll help you remember it. If you owe somebody money, every time you make a payment on a loan or whatever, the loan amount comes down. Well, decreasing term, the face amount, the death benefit of the policy exactly matches what you still owe on the loan. So you make a payment, the loan amount that you owe goes down, the death benefit goes down and matches it, exactly. So what happens if you die while you still have that outstanding loan? Outstanding means you still owe it to someone, and you pass away and you had this decreasing term policy in place, the death benefit would be paid to the entity that had loaned you that money, and it would pay off that debt so the loved ones you leave behind would not have to worry about it. So it's a very specific use for the term insurance. It is to cover a debt while you still owe a lender money on your loan that you haven't paid off. Just remember, it's D for debt. It is decreasing term. The face amount decreases, the premium stays level, and it matches what you owe on the loan. Once the loan is paid off and that balance is zero, your policy would be down to zero and it would be done. Just like your loan is now done because you paid it off.